Michael Cuggino from Permanent Portfolio Family of Funds. Steve Grasso, aforementioned, is here from Stuart Frankel. Rick Santelli, as always, with us from the CME Group in Chicago. Steve, I guess we should start with the NASDAQ turnaround. It was up 1.1% at an intraday record high and is now lower on the day. Why?
So I do think that you're going to have these ebb and flow reactions in the marketplace. Will you take out these historic highs and then you want to pull back a little, build a foundation? But what's really interesting is if you look at these technology names, look at after Netflix reported, you start to see the divergence between a Google and a Netflix. Look at the performance today. Facebook up, Amazon is up, but if you look at Amazon could walk that tightrope. It could be a value, dare I say, stock because it could turn on the spigots anytime it wants. Valuation on a PE level is never going to attract value buyers, but if you look at Google or Facebook as opposed to a CRM, a Netflix, a Workday, the group is diverging. Value versus growth that Bob was talking about before. The market is hungry for growth, so they're looking at technology names, and they're not trading them as a block as they used to. They're separating out those really growthy torque names versus the quote-unquote value name like a Google.
Amazon's a value name at 230 times.
Well, hey, I sat on this desk and I said something weird was going on this desk at $190, and I said, you know what? When you can't bet against Jeff Bezos, when he wants to turn on valuation, he could turn it on, and the shorts run for cover.
Well, it's definitely not a value stock yet.
It is not. It is not. I'm going to go on record. I'm not calling it a value stock. What I'm saying is that it is up with the value names today because the shorts are afraid to bet against it, even at the price it is today.
Rick, talk to us about the two-year auction we saw today. A bit of a flattening of the yield curve and a rise in the short end, not fully offsetting, of course, the steepening that we saw yesterday.
No, as a matter of fact, the bulk of the steepening, 80-90% from last Thursday, is still intact. But you are correct. As a matter of fact, we're hovering right between 263 and 264 right now on a two-year note, settled at 263. It's the only maturity on the curve, Wilf, that is unchanged. Was a few minutes ago up a basis point. 30-year bonds are actually down 2, 10s are down 1. So a little bit. And it isn't anything we should dwell on except for one reason. Many thought that maybe President Trump's comments last week, we know that they definitely helped push the dollar index off of some lofty levels, that maybe his comments regarding the Fed is why the curve changed. But it really doesn't hold water. The short end really hasn't stopped. Presidential comments regarding the Fed and low interest rates aside, it continues to climb every session or so, adds a basis point or 3/4 basis point comping back to 2008, whereas the long end is really where all the steepening really came from, and the long end for the most part are still holding the bulk of the gains as well. Obviously we're not in the 280s anymore, but we have retreated a bit. I think that part of that is in anticipation of some big data points coming up, specifically Friday and our first look at second quarter GDP. Also some of the issues with central banks, Bank of Japan in particular, ECB to a lesser extent, are really juicing the long end. It's not that we're not moving higher. The fact that we're holding those gains after we kind of jumped the broom on a 22-session range is still very significant.
Michael, I wanted to bring up China in this discussion because that's really where things began in terms of the global market rally. Chinese stocks jumping on word that the government there is going to really turn on the spigots. I mean, infusing a record amount of liquidity into the system, issuing infrastructure bonds. So they're in fiscal and monetary expansion mode, and you're seeing energy and materials here in the U.S. outperforming. Is that a play you want to be in, China easing in order to defend against a trade war?
It's very hard to predict China on a day-to-day or short-term basis on what they're going to do, and it's so politically impacted, and given all the trade discussions and disagreements, it adds even more uncertainty to relying on that as a factor. But there's no question in the long term that is a growth economy. It's one of the best growth economies in the world, and so, you know, news like today would obviously drive some of those names, and I think it has. And I would say as a long-term investor, yeah, you want to be in some of those names long-term because I think the long-term story is one of growth in that region. And so to be patient, you can play that successfully. But I wouldn't do it based on short-term news like what happened overnight.
Steve, overall, you actually think it's time to be a bit cautious on markets. So would you a bit of a pullback as much as what, 5%?
So I would say about 4% is probably warranted. If you look at the pullbacks that we've seen, the drawdowns that we've seen back since the February low, then you have the rallies, then the better gauge is to look, a more normal gauge is to look at from April on. So we've had the run-ups, a couple of percentage points, then the pullbacks. And what's more important is the duration that we've seen from the bottoms to those near-term tops that we've seen since April have been about 12 to 15 days. We're already extended about 18 days. So I know this is a huge level on the charts, but we are due for a pullback. And it's normal, healthy to see that, but we definitely are overdue for a pullback that brings us back to, maybe a 4% pullback, gets you down to the 100-day moving average. So I think that's warranted.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.